Imagine watching over $200 million of trader capital vanish from a market in a single, brutal day, all because a line on a chart held firm. That's the raw, unforgiving power of a technical resistance level, and it just happened to Ethereum, triggering a cascade of liquidations that vaporized leveraged positions in a blink. If you've ever wondered why the crypto market can feel like a roller coaster designed by a sadist, what just unfolded with ETH is your perfect, painful case study. So grab a notebook and smash that like button right now, because understanding this event isn't just about tracking a price. It's about learning to read the market's terrifying pulse. We are about to dissect one of the most telling 24-hour periods in recent crypto history, a period that isn't just about a 5.5% price drop. It's a masterclass in market mechanics, extreme leverage, and the delicate collective psychology that dictates whether we soar to new heights or get crushed under the weight of our own ambition. The data we're diving into today isn't speculative. It's pulled directly from blockchain, exchange order books, and institutional ETF flow reports, painting a picture so clear and consequential it's almost frightening. The story begins, as it so often does, at a critical juncture on the price chart that every single trader was watching with a mixture of hope and dread. The formidable $4,200 resistance level. For weeks, the narrative around Ethereum had been building, fueled by a broader market recovery and whispers of institutional adoption finally taking root. The price had climbed steadily from its local lows, carving a path that seemed destined to test this key psychological and technical barrier. This wasn't just any number. $4,200 represents a zone that has acted as a ceiling multiple times in the past, a price point where historical selling pressure has consistently overwhelmed buying momentum. It's a level etched into the memory of every chartist, a line in the sand where bulls and giants clash. As ETH approached its zenith, the entire market held its breath. The order books on major exchanges like Binance, Coinbase, and Kraken showed a massive concentration of sell orders stacked up at and just above the $4,200 mark. This is a visible supply, the wall of intended selling that anyone can see. But beneath that lies the invisible force that truly dictates these violent moves, the perpetual futures market. This is where the real drama was brewing. The funding rates across major trading platforms had turned significantly positive. In simple terms, this meant that traders longing Ethereum, betting on a price increase, were paying a fee to those holding short positions. This is a classic sign of an overheated, overly optimistic market. When funding rates are excessively positive, it indicates that the crowd is heavily leaning one way. In this case, overwhelmingly bullish. They weren't just betting on a breakout. They were piling in with immense leverage, borrowing vast sums of capital to amplify their potential gains, believing that the breach of $4,200 was a foregone conclusion. The total open interest, which represents the total value of all outstanding leveraged positions, had ballooned to multi-month highs. Billions of dollars were now riding on the outcome of this single price level. The market had become a tinderbox of greed and expectation, and the $4,200 level was the match. And then it happened. The price tapped $4,200, hesitated for a moment, and was violently rejected. It didn't slowly roll over. It snapped. This rejection wasn't a gentle nudge. It was a sledgehammer. The first wave of sell orders triggered the initial drop, which was just enough to push the price below the stop-loss levels of the most aggressively leveraged long positions. A stop-loss is a preset order that automatically sells a position to prevent further losses. In a highly leveraged environment, these aren't just sells. They are forced liquidations. When a leveraged long gets liquidated, the exchange automatically sells the trader collateral to close the position, and this selling happens at the market price, irrespective of the current price. This is the dreaded cascade. The initial liquidations create more selling pressure, pushing the price down further, which then triggers the next, larger wave of liquidations at a lower price point. It becomes a self-feeding, algorithmic firestorm. Within minutes, what was a controlled test of a resistance level turned into a full-blown liquidation spiral. The data from CoinGlass and other analytics platforms paints a stunning picture. Over $210 million in long positions were forcibly closed within that 24-hour window. That's $210 million worth of buying power that was not just removed from the market, but actively converted into selling pressure, accelerating the downward move. The chart shows a nearly vertical red candle, a testament to the sheer force and speed of this liquidation event. This is a hidden engine behind crypto's infamous volatility. It's not just people changing their minds. It's a systematic, automated unwinding of risk that feeds on itself. The price didn't just fall, it was pushed by its own internal mechanics. From that rejection at $4,200, ETH tumbled down, breaking through several key support levels that would have normally acted as bounce points. But in a liquidation cascade, support levels, while the cascading liquidations on crypto exchanges with a spectacular high-drama explosion that pushed Ethereum below $3,800. A quieter, more insidious drain was occurring in the halls of traditional finance, one that threatens to exert a far more sustained and structural pressure on ETH's price in the coming weeks. The violent technical breakdown we just dissected was a symptom. The weakening institutional demand we're about to uncover is the underlying disease. On October 29th, the same day the charts were painting a picture of carnage, the nascent U.S. Spot Ethereum ETF market was hemorrhaging capital, with a net outflow of $81.4 million recorded in a single session. This figure, while seemingly smaller than the hundreds of millions liquidated on derivatives markets, carries a disproportionate psychological and fundamental weight. To understand why, you need to appreciate the narrative that has been propping up Ethereum's valuation for months. The story of inevitable wave after wave of institutional adoption following the landmark approval of these ETFs. The outflows shatter that narrative. And if you're not paying attention to this data, you're missing the entire fundamental story behind this decline. Let's break down this $81.4 million hemorrhage. Because the devil is in the devastating details. The outflow wasn't distributed evenly across all the available ETF products. It was overwhelmingly concentrated in a single fund, Fidelity's Ethereum Fund, trading under the ticker FETH. Fidelity, a behemoth in traditional investment world with a reputation for prudence and immense influence over retail and institutional capital alike, saw a staggering $69.5 million walk out the door from its ETH product. This isn't just a number, it's a statement. When the most trusted names in finance see such a massive single-day exodus, it sends a chilling signal to the entire market. It tells us that the very investors who were supposed to be the new, stable bedrock for Ethereum's price, the pension funds, the endowments, the financial advisors allocating client capital, are getting cold feet. This isn't the hot money of a crypto degen trader on leverage. This is the cold, calculated capital of Main Street America, and it's retreating. The reason this is so critical is that the entire value proposition of a spot ETF is that it creates a constant one-way pressure valve of demand. The issuer must buy the underlying asset, in this case, ETH, to back the shares they create. Conversely, when shares are redeemed and the ETF sees outflows, the issuer must sell the underlying ETH from their vaults. This means that the $81.4 million in net outflows directly translates to a requirement for the authorized participants and issuers to sell approximately $81.4 million worth of Ethereum on the open market. This is a direct, mechanical sell pressure that exists completely independently of the emotional liquidations on Binance or Bybit. It's a slow, persistent drain, not a sudden explosion. Now, let's connect the dots between the ETF outflows and the technical breakdown. They didn't happen in a vacuum. They are deeply intertwined. The initial rejection at $4,200 and the subsequent long squeeze created a sharp, ugly red candle on the chart. For a traditional asset manager or financial advisor who is already skeptical about the volatile nature of crypto, that price action is a powerful deterrent. It validates their deepest fears about the asset class's instability. So, seeing that volatility, coupled with perhaps broader macroeconomic anxieties like lingering inflation or shifting interest rate expectations, they make the decision to pull capital out of the FETH ETF. This redemption order forces Fidelity to sell a chunk of its ETH holdings. That selling adds to the downward pressure on the spot price, which in turn further spooks the market, potentially triggering more technical breakdowns and more long liquidations. It becomes a vicious, self-reinforcing cycle between the traditional and crypto-native markets. The ETFs, which was supposed to be a stabilizing force, can, in times of fear, become an accelerant to the downside. This is the new, complex reality of Ethereum's market structure. It's no longer just about decentralized finance and retail speculators. It's a hybrid monster, where a whale on a derivatives exchange can trigger a crash that causes a pension fund in Iowa to sell, which then fuels further crashes. This $81.4 million outflow is a stark data point suggesting that the institutional easy money has already been made. The initial frenzy of buying after the ETF launch has subsided, and we are now in a phase where these products need to demonstrate sustained, organic demand to justify their existence and their impact on the underlying asset's price. The fact that we are seeing significant outflows on a day of sharp price decline indicates that the current holder base in these ETFs is not comprised of diamond-handed, long-term conviction holders. They are fair-weather friends, and at the first sign of storm clouds, they are heading for the exits. This creates a fundamental headwind that pure technical analysis might miss. You can draw all the support lines you want, but if the ETFs are consistently seeing outflows, creating a constant drip, drip, drip of sell-side pressure, then those support levels are far more likely to break. The price slide to below $3,800, therefore, is not just a technical event. It is a fundamental repricing based on... So we have the perfect storm, a technical liquidation cascade meeting a fundamental drain of institutional capital. But to truly understand the gravity of Ethereum's current position, we must zoom out from its own chart and place it squarely within the context of the broader digital asset universe, because the comparative performance data tells a story that is arguably more damaging than the price drop itself. While the entire crypto market cap fell by 4.29% during the same turbulent 24-hour period, Ethereum, the king of altcoins and the undisputed number 2 asset, slid a more profound 5.5%. This 1.21 percentage point of underperformance is not a random statistical blip. It is a critical market signal, a loud and clear message in the collective intelligence of the market that Ethereum is currently facing unique headwinds that other major assets, most notably Bitcoin, are not. This relative weakness is a phenomenon often referred to as beta underperformance, where an asset falls more sharply than the market during a downturn, and it speaks volumes about shifting investor preferences and a potential rotation of capital that could have lasting implications. When the tide goes out, you see who is swimming naked, and right now, the data suggests Ethereum is looking a little more exposed than its peers. This underperformance didn't start with a single event. It has been a developing trend that this sell-off has simply thrown into sharp, unflattering relief. For weeks, the conversation in crypto circles has been dominated by the staggering inflows into US spot Bitcoin ETFs, which have been sucking up available BTC at a pace that dwarfs new supply from miners. This institutional narrative has been almost exclusively a Bitcoin story, creating a powerful gravitational pull that draws capital towards BTC as the safe haven, institutional-grade digital asset. Ethereum, despite its own ETF approval, has been left in the shadow of this monumental capital allocation. The recent ETF outflows for ETH, which we just detailed, stand in stark, painful contrast to consistent multi-hundred million dollar inflows that Bitcoin ETFs have been enjoying. This creates a divergent fundamental reality. Bitcoin is seeing constant, structural buy-side pressure from traditional finance, while Ethereum is experiencing the opposite. This divergence naturally manifests in their relative price strength. During times of market fear or uncertainty, capital tends to flow towards the asset perceived as the safest, most established, and most liquid, the blue chip. In the crypto world, that is unequivocally Bitcoin. So, when traders and institutions decided to de-risk following the rejection at $4,200, a significant portion of the capital that flowed out of Ethereum did not simply go to cash. It likely rotated directly into Bitcoin. This is a classic flight to quality trade, and it exacerbates ETH's underperformance. The selling pressure on Ethereum is not met with equal selling pressure on Bitcoin. In fact, Bitcoin often benefits from this very dynamic. This rotation is further fueled by the different narratives surrounding the two assets. Bitcoin's narrative as digital gold and a macro hedge is simple, easily understood, and resonates deeply in a fraught macroeconomic environment. Ethereum's narrative is more complex, built on its utility as a world computer, the foundation for decentralized finance and the home of non-fungible tokens. While incredibly powerful, This narrative is also more fragile and more dependent on a thriving, risk-on ecosystem. When the broader market sentiment sours, the complex, application-driven narrative of Ethereum often takes a backseat to the simple, store-of-value narrative of Bitcoin. Furthermore, the technical breakdown itself played a role in this underperformance. The massive $210 million long liquidation in Ethereum was disproportionately large compared to similar events in other assets. This suggests that the leverage was more heavily concentrated on the long side for ETH, making it more vulnerable to a violent deleveraging event. When those highly leveraged ETH positions were wiped out, the resulting selling not only crushed ETH's price, but also likely provided the capital or the motivation for traders to move into less volatile, less leveraged positions in Bitcoin. This underperformance is a critical data point for any serious investor because it challenges the assumption of a monolithic crypto market that moves in perfect lockstep. It doesn't. Assets have different risk profiles, different investor bases, and different narratives, and they will perform differently under stress. Ethereum's sharper decline is a warning sign that its current market structure and narrative are less resilient than Bitcoin's in the present environment. It indicates that for all its technological brilliance and the confluence of a technical liquidation spiral, a fundamental institutional outflow, and stark relative underperformance has now brought Ethereum to its most critical technical juncture in months, a point where the charts are no longer just reflecting past pain, but are actively mapping out a very precarious future. The breakdown below $3,800 was not merely a breach of psychological round number. It was a decisive crack in a key support structure that had been patiently building over weeks, and the resulting chart pattern now suggests that this recent slide could be the opening act of a much deeper and more severe corrective phase. Let's navigate this treacherous technical landscape together, because what we're seeing on the screen right now is a classic, textbook example of a bearish breakdown, one that could redefine the trading range for Ethereum for foreseeable future. The most immediate and alarming development is the decisive breach of the 50-day simple moving average, a widely watched dynamic support level that had faithfully cradled the price on every single pullback during the recent bullish ascent. This moving average is more than just a line. It's a consensus representation of the medium-term trend, and when price slices through it with the kind of velocity and volume we just witnessed, it's a clear signal that the underlying bullish momentum has not just paused, but has been fundamentally broken. This breach signals to algorithmic traders, quantitative funds, and technical purists that the trend has shifted, triggering a new wave of automated selling. But the damage runs even deeper. The entire price action from the late September lows to the recent $4,200 peak now forms a distinct and potentially devastating bearish pattern known as a rising wedge. This pattern is characterized by its converging upward sloping trend lines, and it is notorious for its false promise of continued rally. The pattern forms as price makes higher highs and higher lows, but it does so with diminishing momentum, creating a narrowing coil that typically resolves not with a breakout to the upside, but with violent breakdown to the downside. The recent rejection at the upper boundary of this wedge, coinciding perfectly with the $4,200 resistance, was a trigger for that very resolution. The subsequent plunge, which took the price clean to the wedge's lower support trend line and below the $3,800 level, confirms the pattern's bearish implication. According to traditional measuring technique for a rising wedge, the projected price target is often derived from the height of the pattern's widest point, projected downward from the point of breakdown. Applying this crude but often effective metric to the current setup paints a sobering picture, suggesting a potential pullback target that could reach as low as the $3,400 to $3,500 zone, a region that also conveniently aligns with the next major, historically significant support cluster around the 200-day moving average in the early October consolidation range. This is not a prediction, but it is a very real and statistically probable path that the charts are now indicating. The momentum indicators confirm this bleak outlook. The Relative Strength Index, or RSI, has not only broken below the key 50 level, signifying a shift from bullish to bearish momentum, but has also plunged into oversold territory. While an oversold condition can sometimes precede a short-term bounce or relief rally, in the context of a major pattern breakdown, often signifies that the selling pressure is intense and likely to persist. The bounce, when it comes, Maybe nothing more than a retest of the broken support level, which has now turned into a new resistance. The old floor becomes a new ceiling. This means any attempt by the price to recover back towards the $3,800 to $3,850 area could encounter a fresh wall of selling from those who bought the support and are now looking to exit at break-even, and from new shorts entering the market. The volume profile during the breakdown adds a final, confirming piece of evidence. The down day on the crash was accompanied by significantly higher volume in the preceding up days, a clear sign that the selling was driven by conviction and panic, not just a lack of buyers. This high volume breakdown validates the significance of the break, making it far less likely to be a false signal or a bear trap. So where does this leave us? We have a market that is technically broken, having violated its primary uptrend support. It is fundamentally pressured, with ETFs bleeding capital and creating